economic catastrophe is about to happen, and we must prepare. Welcome to Finan Simple, where money is made easy. And today, we shall prepare you for the upcoming crisis. Jay Powell, the chairman of the Federal Reserve, promised for almost 2 years straight that inflation won't get out of hand. This was despite interest rates being at a minimum. So, what happened in the last 6 months? The Fed raised the rates 3 times and started to shrink its balance sheet. The first increase was last February by 0.25%. It wasn't that impactful, but it sent a message to the market letting everyone know the age of cheap money is over. Sadly, it was ignored. March saw the Fed raise the rates by 50 basis points. What happened? The market went down, tech stocks crashed, and crypto became crypto. Coins such as Luna went from a promising project to bankruptcy. Coins that were affiliated with the dollar even lost half its value. How is that even possible? Investors simply stopped believing in crypto. Investors started bailing out of their positions before it all collapsed. However, this wasn't the end. June saw Jay Powell announcing that the Fed will raise rates by another 75 points. This was met by chaos in the market. It destroyed the stock market and even made the housing market's future questionable. Interest rates at 1.75% would make mortgage rates so high, it would be difficult for most to afford to buy a house. Those that can will have a great impact on their budgets. This will reduce demand, eventually leading to lower prices. Now, how did this affect crypto? Well, if a 0.5% increase nearly wiped it off the market, what would a 0.75% increase do? Bitcoin crashed by 33% by the 6th of June. Other coins such as Solana cost a fraction of their value at their peak. I bet Ethereum will cost less than $1,000 in the coming months. It's scary because this is yet to be the end. Jay Powell suggested that July will see rates increase by another 0.75%, raising interest rates to around 2.5 to 2.75%. The last time rates were this high was March 2008, when the Fed raised interest rates trying to control the housing market. Could this possibly signal another step toward recession? How bad will it actually get? How will this affect the stock market? How will this affect your family? Janet Yellen, former chairman of the Federal Reserve and the current Secretary of the Treasury, addressed these questions. The top priority should be reducing inflation, as she stated during a meeting with the Congress. This only proved that inflation is indeed getting out of hand. A year ago, we saw headlines that read, "Raising wages will not be enough to keep employees. Higher wages will only lead to higher costs, which will show in prices. If the Fed raised the rates, it would destroy the market and unemployment would skyrocket." Big name companies have already been reducing their workforce. Industry leaders like Coinbase have laid off 18% of its workers. Ex-employees confirmed on LinkedIn that Tesla has also started reducing the team by 10%. Elon Musk hinted that there was bound to be layoffs at Twitter despite ongoing negotiations. Even PayPal has been firing workers since May. The age of cheap money is a thing of the past, and tech companies are now preparing for the storm. As unemployment rises, lower demand will soon follow. What is a recession? A widespread crash in spending activities, an overall decline in economic activity. If this decline lasts longer than 6 months or 2 consecutive quarters, it now becomes a recession. A reduction in real GDP, real income, and employment will also be indicators of a recession. It's only a matter of time until we see an increase in unemployment. If these conditions last for 2 years or more and GDP shrinks by 10%, it's now a depression. 2020 would have been the beginning of the next depression if not for monetary policy being loosened by the Fed. Loosening monetary policy may help in the short term, but it only defers the cost to future generations. Sooner or later, the money spent must be paid for by the taxpayer. This was the Fed's plan all along. However, the US is being forced to act now as a geopolitical crisis is occurring and there is a pressure to take action before it's too late. If the US eases monetary policy to appear to solve its current issues, a catastrophe is looming on the horizon. A big crisis, the World Bank suggested another 1970s stagflation crisis in which inflation continued to increase even as Americans lost their jobs and unemployment continues to rise. Prior to the 1970s, traditional economics believed inflation would lessen if unemployment were to increase. This is because people would have less money to spend, making prices go down. However, the average person does not think about the logistics of a supply chain. Production and delivery of goods cost money, and almost every transfer takes fuel to achieve. Inflation kept on rising even when the economy fell into a recession. This cast a shadow on the Fed's ability to fight inflation. Inflation became so high, it needed two devastating recessions to finally get control. Paul Volcker led the Fed and raised the federal funds rate to 90% and finally controlled the chaos. With what's happening now, we could see the same turn of events in the near future. But how far should the Fed go to calm down inflation? 5%? 19%? Could we see a return to rates of the 1970s? If rates were to even raise by 5%, the effects would surely be devastating. We have already seen the effects of a 1.75% increase over the past few months. How long will increased rates last, and how long will it take for the market to adjust to the new cost of doing business? We see that the rising interest rates cause employers to shrink staffing due to the rising cost of interest. As rates rise and the cost of business increases, employers must reduce overhead to remain in business. Unemployment will rise and the demand for goods will decrease. Experts have a real concern that a recession isn't the worst case scenario here and that stagflation is. How will this affect the housing market? Just how much can high unemployment and high mortgage rates affect the demand and lower prices? Will prices even fall during inflation? Predicting the future is a gruesome thing to do, but what economists have agreed upon is that what will happen in the future will surely leave a scar. A small increase in interest rates and the stock market will implode, as a dollar today won't be worth a dollar tomorrow. Always stay focused on learning and developing discipline. Get educated, make a plan, and stay the course. If you found this informative, smash the like button, please share it with a friend, comment down below, and let us know what you would like to have made finance simple next, and definitely subscribe so you don't miss new content. Keep your head up, ears open, and always search for knowledge. See you soon!